interesting to work with those prestigious global financial institutions from Hong Kong, Singapore, New York, London, and some of the major financial hubs around Singapore, New York, London, and some of the major financial hubs around What's going on, guys? This is Baro, aka Invest Mentor. Thanks for your time and watching again. Today is September 21st. It's another Tuesday, and today in the live stream, as usual, we're gonna just like talk about some of the major event in like global financial market. And I think like as like most of you have already paid some attention to the the potential like crisis trigger, like a China Evergrande, right? The China Evergrande. What is China Evergrande? That is the biggest Chinese real estate developer, and that accounts for over 6% of the entire market share in in China, the real estate development business right now. And later on, like today, we're gonna see. We're gonna know like why it's like causing like it's like just like causing like a problem, causing a crisis for global financial system. And we're gonna see like how we can react. What will be some of the action? Because like in the past, like a live stream and short video where I've been like talking about that over and over again, saying like in every crisis or potential crisis, like just stock market crash, actually that would be a good chance for us to to take profit, right? To buy the dips otherwise. So that's why, like, once again, why I mean the rich always become richer and the poor always become poorer during financial crisis, during in just we say like like from the history, right? In every war, like some people just suffer to become like to have a to living a worse life, and but some people just got a chance to we can say they got a chance to loot, or just just like take things from the others to become wealthier and richer and more powerful. And it's the same for like financial war or like financial crisis. So um okay, so like and I see like but I'm sorry, we have to say that again, like today um I have to apologize that because of like some system issue, like before we just we just started a live stream. I was just working on some like system issues, system glitch on my OBS and some of the music issues. So I was a little bit like scrambling, a little bit not like fully well prepared for the live stream right now, but it's fine. We can always be more improvised. And but like before everything, we also have to mention that everything in the live stream, in the YouTube channel Borrow Investment Tour, is solely for entertaining, educational, informational purpose only, without any just financial advice. I'm not a licensed financial advisor. And okay, so today let's try to be a little bit chill a little bit and relax, just to understand what's going on for the potential issue for like China Grande, and how we can react with some of our stock trading and investment. And the market, the US stock market just open for a minute. So let's see what's going on right there. Okay, so we can see that right now the in my watch list, the top market mover today is METX, Meta Holding, and Uber. Meta Holding is up for about like 9.6%, and Uber is up for about 7.7%. And we don't see some of the popularly traded tickers here. And then so what's the overall market? Okay, so the market is in a mild rebound so far. Like we can see like S&P 500 is down for about 0.4%, and Dow Jones is down for sorry, S&P 500 is up for about 0.39%, Dow Jones is up for about 0.4%, and Nasdaq is up for about 0.4% as well. So the market so far, at least, I mean, the US stock market are not like, are not too nervous. Are not too nervous. These not like, just crashing further so far. And then let's see. Let's just uh quickly go through some of the news. Like we can see like Evergrande, right? This is actually Evergrande. The problem, like, let's come back to see part of Evergrande first. It's like listed in Hong Kong Exchange, and it's been listed in Hong Kong Exchange since like 2010. And then the price, I mean, the stock price of Evergrande just like exploded, surge in before 2018 in 2007. In 2007, it just like soared from like 3.5 all the way to about like $31, and then just like just just a wild fluctuation all the way to pull back until, let's go into a daily chart. You can see, so it's just like just like fluctuating up and down from like 2008 to like 2000, and then we just have the we just saw the debt issue for Evergrande like a couple months ago, and then the debt issue just like started getting, I mean worse. I mean, like 2 months ago, and then the bump price, it started with the bump price first, like because China Grande is let's see the financial of like China Grande. You can see that's the this is the annual financial for Evergrande. So you can see the let's see the balance sheet. Okay, let's have a quick look into the balance sheet. So the total liability here is a total liability here for Evergrande from like 2016 to like 2020 last year. Just I mean, just like rose all the way from about like 1.3 trillion to 2.3 trillion. This is Hong Kong dollar because it's listed in Hong Kong, so this is Hong Kong dollar. So you can do your calculation to make that into US, make that into USD, right? So in, let me see. Okay, so it's about like 300. It's like the total liability for China Grande. I mean, last year, by the end of last year, it's like about like 2.3, 2.5 trillion of Hong Kong dollar, which is equal. Equal to about like 300 billion US dollar, 300 billion. Okay, remember the number. Okay, 300 billion US dollar is the amount of liability China Grande hold. I mean, it's even holding a similar amount of the liability right now. And China Grande has the total, let's see, the total equity. So the equity is about like 420 billion. So it's about like a 50 billion, right? So the so we can see, so the the liability to equity ratio for like China Grande is about like 6 to 1. It's about 6 to 1. Okay. So we just had this is a very like simple like understanding. We can know like what's going on for the financial structure of like China Grande. So we will have like better picture to see like if it's really a problem. I mean, once it causes a crash in the global financial market, if the crash is gonna be really, really, really bad, or it's actually just it actually potentially just a false alarm, a false crash, a false financial crisis, right? If it's a false, we cannot say false financial crisis because like once the market crash, it crash just crash, right? But we can, for every financial crash, we as an investor and trader would always try to understand if that's a like 30%, 50% crash. We it's better to know it's if that really worth that much, just terrible correction, or it's maybe just like 5% at the most, and the rest of that will be the the super yummy huge discount like for us to buy the dip, right? That's the point. That's the point. So we don't have to be afraid of any crash. We don't have to be afraid of any financial crisis. Seriously, this is really important. Like whenever you hear, you or you are aware, or you smell any sense of like financial crisis, or like market crash, that's a good sign. That's a good sign. That's like that's the smell of money, right? That's the smell of money, and that's the smell of like easy money. You can make money like much faster than the time of the time of like the time of the peaceful time, right? So okay, so I'm too far again. So back to like China Grande, the liability to equity ratio for China Grande is like 6 to 1. Which should be not too bad, right? Remember, like let's try to recall, like what is happening 2007, 2008, the subprime mortgage crisis, and the Lehman Brothers just like went bankrupt, right? Lehman Brothers just went bankrupt. So today, we're gonna go through. We're gonna share some old article here. We have like 7 mind-blowing numbers from Lehman Brothers disaster, and this article was publishing actually like 2013. That's a long time ago, but this is very interesting, and we're gonna see what will be the number. So give me a second. Sorry for the pause. So yeah, I mean I mean today I just just since we I mean we're gonna talk about the sorry, I'm not sure if the music is kind of like too loud or is okay. Please let me know if it's fine. So, yeah, hi, it's Zoe, Sophia, and Soda Cookie, Michael, Barry. Thanks for coming. Thanks for your chat. So yes, this is I'm going to share some information that we had from the subprime mortgage crisis. You know, some of the figure we got from Lehman Brothers bankruptcy. You know, yeah, stock market just had a crash. It's volatile yesterday, and you know it's been saying a lot of like gossip saying we will have the contagion, right? It's a very it's a very it's not new, but the word I mean just getting popular contagion, right? In financial market, right? And do you think it's another housing bubble like what happened in Japan 30? Uh, Actually, to be honest, I don't think it's really a housing bubble. I mean, if we try to, find some information in, the housing price in like Japan and, just the US and China, you can see the amount of increase was is not is totally different. I mean, between among these three markets are totally different. And in the past couple of years, along the way, I mean, China government has been just imposing all the crackdowns and restriction, not only in financial market but also in housing market, right? So I mean the housing price, I mean it's I mean have been getting higher and higher because the socialism system, the communist system has been just mixed with a lot of the capitalism, right? So that's how they I mean that's how they have the development, right? That's how they have the development progress, but also have some of the we are not sure if it's a bubble yet. A lot of the just the price rising, the price increasing, all the assets including real estate. But I mean the Chinese housing, I mean I wouldn't say it's a bubble there. So like so next time like I will try to prepare more data to show you why it's not really a bubble for Chinese I mean housing market. Like but why like the biggest like real estate developer just had a debt issue, why they cannot pay back the debt like right now, they're going to be in default. I mean, there are like many different reasons, just like the increasing house price. I mean, the rising the increasing like housing prices is one of the issue, and but also because of the COVID-19, the China economy has been like impacted a lot in the past like 1.5 years. So a lot of like so that's why they try to just stimulate the domestic consumption and all that, domestic economic activity and all that. And but of course like um a lot of the problems still like brewing in the past like 1.5 years. That's how like the Evergrande just ran into the situation today. So that's a brief from my 2 cents. But of course you can read some more information than they will. And when you read information, like when you read information from like for example, when you read like English report, it's gonna be different from the report you read from like traditional Chinese, because that's probably published by Taiwanese or like or Hong Kongese, and then it's also gonna be different from the report you read from just like simplified Chinese, like that's probably from like just published by Chinese, right, from Shanghai or Beijing, and there are like just like way too many different opinions and the perspective. And to be honest, I think I mean a lot of the time we just sorry about my chair. A lot of the time we just need to be more independent to like we just have to think independently, right? We read a lot of information, and then we just digest, we just to have our own thoughts, right? But anyway, I don't think it's a housing bubble. It's just it's just not a bubble. Yeah. So no, so I mean, so far like no, I mean, no one is really saying it's a bubble right now, but it's saying like the debt issue. They are saying yeah, there are a lot of like just because like the global market has been like criticizing on like China in from all aspects, from the stock market, from just they have like a fraud, like the locking coffee, they have the fraud, the accounting fraud, and then later on the China have the crackdown like all over like in all the industry, and right now they have like the real estate developer like Evergrande's like debt prices. And um so sometimes I would say uh it we have to tell if a lot of time I think like nowadays like after 2000, especially after 2016, I mean the technology explosion, innovation, like big jump, like we have like too much information, like too much data to get exposed to. And and how we can digest, how we can analyze, organize. Organize those data would be another issue, right? We I mean, it's a time we can choose to be either more like either more like seeing the world more like clearly, or I mean, or become becoming just more blind, right? Becoming more blind because like there too much white noise right there. And a lot of time, I think like just like we like so, like in the past 2 years, now we have like homey economy. We have a lot of like influencer, right? Like like Trump become an influencer, and the Elon Musk become an influencer. So a lot of times I people's opinion and the I mean the I don't know how to say the truth or the fake news. I mean, how we can tell. And sometimes like when the fake news is like repeated over and over and over again, and then uh, it might become a truth, right? And when a truth is it, I mean, it's like hidden or like potentially intentionally, just killed like over and over again, then I mean, no one can see the truth, and then it won't be a truth somehow. Somehow. I'm not. It's not always the case, right? But it's sometimes the case. So what I was saying is that I don't. Okay, so just make it simple, right? Just I don't think like Honda, like Evergrande, is real, is truly a problem to make a disaster in global financial system. So if I mean like we will see like what's going on, right? Like in the they will have they will have they will have they will they just Morningstar and Bloomberg just saying like S&P 500 just say uh Evergrande may have default on Thursday, right? 2 days later. And but so what? So what? So what? I mean, think about that. So that's why we need to check into some of the figure here. So like how bad it can be, right? For example, it's a case, right? We talk about like George Floyd, like how should I pronounce it? The George Floyd, right? George Floyd is the black who just got like just killed by accident by police in the U.S. and then just leading to uh just a whole rave of the protest in the U.S. like calling out for like Black Life Matter, and then this even become like contagion event like into like Europe, into France, into Britain, and all that, right? And that's the life from the guy called George Floyd, and um, so I this is I think this is very serious. This is very serious kind of. But I would say these kind of things probably just happen like I don't know, like 100 or 1,000 times a year in the US. I don't know. I just make a guess, right? And I read there are actually hundreds, thousands of like um just violent just police uh murder like in the US like every year, right? And then but like 99.99% of them are just ignore or like forget. But why George Floyd just like just came out, just pop out like to become noticed. So I mean, of course, like there will be a lot of factors, right? There will be a lot of factors, but so I mean, for a lot of things, it really depends on the who and when and what and how, right? So, but we let's come back. Let's come back. So, um, think about the aftermath of like George Floyd's like murder. Like we have like so many protests. Like that protest we can. It really depends on like how you think, right? You can be positive. You can be negative. It's I mean actually the aftermath we have a lot of like violent, a lot of like looting, a lot of like the riots in all the cities like across the country of the United States, like causing like a lot of like just loss in assets, like a lot of like you burn a house and like destroy things. So if you compare the value we were trying to find from that case and the value I mean the physical value we actually lost. I mean um you can do the math, right? You can do the math, right? So I think that's also something like similar to uh, a lot of the financial crisis. There are big financial crisis, there are small financial crisis, right? So okay, I'm too far again. So like back to like a Lehman brother, back to Lehman brother. So we were saying we just like in the chart here we just like check into China Evergrande's like debt to equity ratio, which is about like 6 to 1, which is about 6 to 1. And the amount of liability is about like 300 billion US dollar for China Evergrande. And then the seven mind-blowing number from like Lehman Brothers. So we can see like at a time we can see Okay, so Lehman Brothers at the time, the leverage ratio, the liability to equity ratio for Lehman Brothers was about like 24 to 1. Okay. And at the time, for a lot of like US bank, the liability to equity ratio, like for Morgan Stanley back to like 2008, right now it's a little bit different, but it's still very high. I mean, that's the nature for like I mean, the American bank, because, American bank has the power, has the, have the privilege of like, just like issuing, just like controlling a lot of like US dollars. So that's what. And Morgan Stanley has the, liability to equity ratio about like 30 to 1, you know. So, and Bank of America, it's it's like 28 to 1. So in comparison, the leverage for these US banks is much, much, much higher. Okay. And then we can see, okay, we can see like Lehman's largest single line items on its balance sheet was financial instrument and other inventory position owned at about like 217 billion. You know, that's the amount we look for. Less than 300 billion, less than 300 billion, but around similar, right? Around similar to, um uh what like China Grande has. So you might think, oh, they have like a similar amount of liability or debt. So, oh, like if like China Grande really get fucked, like, the result, the consequence, is it gonna be like, the same, we got in 2008, so, but the thing, okay, I'm like kind of like detouring too much. Okay, so please, I think about the thing I just like mentioned, and then we will go into more detail in a minute. I'll be right right. Okay, sorry for the pause again. So, let's see. Okay, so they pay. I mean, from the for the I mean, for Lehman Brothers bankruptcy, they. I mean, from like 2012 to 2014, they just pay like 2.25 billion to solve the problem. 2.25 billion. That's a lot, you know. But this is even this is, I mean, 2.25 billion. Remember the number? Okay, so they have, I mean, they have the debt less than 300 billion, and then they have the problem, you know, to solve the, you know, they just made that 300, they just have the issue to make that 300 billion structure kind of thing just explode, right? Screwed. So they, I mean, later on they have to pay like 2.25 billion to fix that, structure. Okay, so that's about how much? That's less than 1%. That's less, but still a lot, right? 2.21 billion. And then what about sorry, that's the 2.25 billion. I will copy and paste the link there. So you can always like Google like 7 mind-blowing numbers from the Lehman Brothers disaster by yourself as well. And you can check a lot of this kind of information, you know, this is really interesting. And then 2.25 billion, right? According to that's the amount paid. You know, the 2.25 billion here is on top of the cost of the fee racked up prior to 2012. Okay. So what about these like 250 million? Okay. Believe it or not, this was the amount Barclays paid for the investment banking and capital market operation that it purchased from Lehman. Okay, what does it mean? After subprime mortgage, right? The Barclays just like, you know, reach out to bail out, to buy the investment banking business of Lehman Brothers, right? And Barclays just called up about like 100.75 billion for the purchase, and 1.5 billion of that was allocated to real estate. Okay, so I mean, we just talked about the entire like you know, it's like 250 million, or the entire like 1.75 billion. That's the amount. That's actually the amount lost. That's actually the amount lost from the you know, at least I mean that's the very initial number, very clear number we can see, right? You know, without any knock on effect, without any before any every like ripple effect, before every chain effect. That's the amount, you know, Lehman Brothers lost, right? Lehman Brothers screwed, right? And that's the amount just got evaporated from Lehman Brothers, like, you know, wrongdoing. You know, just about like $1.75 billion. Okay, and that, and you can even say that is the, you know, the first straw crashed the camel's back, right? That's the number as the first straw to crash the camel's back. Okay, 1.75 billion. Is it? You can think about it. Is it a lot or what? Is it a lot? So remember the number. We just say 1 to 2 billion. 1 to 2 billion. Okay. So let's come to another guy.